Founders Forum, Episode 3.
Open your mind to a new episode of the Founders Forum, the podcast championing a free economy, sound assets, and blockchain solutions. Each week, your hosts, entrepreneur Cole Snell and economist Bob Murphy, interview pioneers and free thinkers to help you develop into the architect of your future.
Welcome back, everyone, to another episode of the Founders Forum. Today, we are pleased to be speaking with Lowell Ness, who's a partner at Perkins Coie. And let me just explain to you listeners up front the distinction that you're going to have to learn as you listen to the podcast going forward. There's a difference between cryptocurrency and a security token. Now, these both use blockchain technology, but these are not interchangeable terms. And so just keep that in mind as we go forward. Lowell is an expert on security tokens. And so that's what Cole and I are going to be asking him in the course of this interview to elaborate on that. But I just wanted to make clear that distinction up front. So let me just read a little bit from Lowell's official bio here so you have an idea of his background and expertise. Lowell Ness is a partner in the firm's corporate practice with considerable experience in securities law and corporate governance matters. He serves as lead of the FinTech corporate financing and M&A vertical of the FinTech industry group. His practice focuses on high-growth emerging companies and involves venture capital financing, merger and acquisitions, public offerings, and private placements. His clients range from startup companies in the earliest stages to well-established public companies, as well as private equity and venture capital funds. Lowell regularly acts as either company counsel or investors counsel in venture capital financings. He has also acted as either company counsel or underwriters counsel in public offerings for several high-profile clients. He's taught a course in securities regulation at Santa Clara University School of Law, and he's a frequent speaker at national MCLE seminars on topics such as legal opinions, drafting stockholder agreements, corporate governance, and mergers and acquisitions. And finally, of particular relevance for our discussion here today, Lowell is also a core member of the blockchain technology and digital currency industry group, where he focuses part of his practice on assisting blockchain, Bitcoin, and other cryptocurrency clients raise money by maintaining relationships with key venture capital groups and other potential investors in the industry. He's very active and well-known in the industry and often speaks on the subject in San Francisco and Palo Alto through meetup groups at Hero City and other startup workspaces. But again, I do want to stress that Lowell, his area of expertise is not merely in cryptocurrencies, but also what are called security tokens. We're going to focus on that in the interview. So without further ado, here is our discussion with Lowell Ness.
Lowell, super happy to have you here today. Founders Forum, obviously we'd like to dive into questions facing founders, the lifeblood of community. I kind of figure that entrepreneurs and founders are the people out there in the economy taking all the risks and sometimes reaping some of the rewards. What are you seeing out there from your perspective? What are founders challenged with? What are you excited about for founders, entrepreneurs, the whole bit?
Yeah, obviously we're in an interesting place for fundraising, and it's a lot more challenging this year than it was last year. Last year was a pretty good year for fundraising, but this year I think is going to be harder. On the one hand, that's probably a good thing every so often to take a break and focus on product development. I'm kind of looking forward to seeing what comes out of this year's, kind of refocused efforts on new products. But my guess is we're probably not going to get too heavy into the fundraising cycle until probably, later summer and fall of this year.
Lowell, can I push you just to elaborate on, is it that last year was like, it was too easy and now we're moving back towards a more sustainable baseline, or is it that this year's really dried up?
It's a good question. I would say in general, all the good projects are still getting funded. It's not like it's dried up completely. It's just, I think the mindset of investors has shifted and people are kind of watching the Fed. They're watching, for the macro indicators to sort of get back into the game. And if we do get, a real soft landing, I guess it could accelerate things, but my guess is people are going to take wait and see mode. Fed's going to raise a couple more times, at least it sounds like. And so people are going to kind of wait to see what that looks like. And they're going to be, kind of on the sidelines with cash because everybody feels like the market in general is kind of too high. And so cash is the place to be until they see signs of recovery. And that could take till, I think, the third or fourth quarter.
I like something that you said about, just to kind of paraphrase a little bit, about the projects that say do get funded in the next few months, early 2023, maybe prime. And I guess this is a question. I want to know if I heard you properly. Are they projects that are offering more value? Is it forcing founders and CEOs that are looking for, seed or early stage financing for different projects to essentially do a better job with the product and the value that they're offering?
Yeah, evaluations always kind of get impacted in situations like this. And it's one of the things that I think founders should not worry about too much. If you can get a deal done, even if it's at a lower valuation than you were going to get last year, honestly, valuation is maybe only the third, most important priority in fundraising. So I wouldn't worry about it too much. I think you need to, if you need to raise money to keep the product development going, then do it, and I think, give up the valuation and get it done. But I think yes, I think we're going to see the deals that do get done are going to get done at probably lower valuations than they would have been done last year.
Can I ask you, Lowell, I'm wondering how much, because obviously there's in the news, like people who weren't even into crypto or anything like that, they hear about FTX and all these various things. Is there a sense that, some investors maybe thought like, oh, gee, I don't want to miss the train's leaving the station. I don't want to be left behind. But now they're skittish, even if the particular projects don't really have any of the same vulnerabilities as some of these, high level scandals of 22?
Yeah. I mean, especially to the extent we're focusing really on crypto, I would say, honestly, this is a moment where like the watchword at the meetups I've been to recently is boring is the new sexy. And honestly, what people are looking for is basic blocking and tackling and like doing things that are just not going to the moon. They're looking for things that are kind of just smart projects, smart people, very understated, as opposed to the FOMO backed. Like FOMO has become a bad word. And so I think that's what people are kind of looking for in crypto projects post FTX. And I think the other interesting thing about FTX is that it's kind of signaling to a lot of the sidelines, real deal kind of Fortune 100s that have been thinking about crypto for a while, that maybe now is the time to get in. And I think they've been kind of biding their time and looking for an opportunity to displace some of the projects that were, a little bit too fanciful. And that may be what ends up happening here, where you start to see some of the real incumbents in the financial services ecosystem start to actually get into crypto for the first time because they're sensing this as a market opportunity for them. And I sort of take this long-term perspective on crypto, where it's eventually going to be everywhere and ubiquitous, and it's just a matter of timing.
Boring is the new sexy.
Yeah.
And so don't advertise 90% APY.
Yeah, exactly. Yeah. I mean, listen, 90% APY is like conservative. I mean, I think I saw 10,000% APY on some of the billboards.
Did I say 90? I meant 10,000.
Yeah. I mean, it's just ridiculous stuff, right? I mean, just patently obviously bad. But, that's been where crypto's at, for the last few years in the DeFi space. And it just needs to kind of settle down and be real and start to get into kind of a more normative phase and I think that's what's happening is the real deal guys are starting to use crypto to get into the crypto space and use the technology to bring products to market. So I think we're going to see products coming from entrepreneurs and founders as well as incumbents. And we may see a lot of M&A as a result, because I think the incumbents are going to be doing some buy versus build analysis for themselves as they think about getting into the market. So I kind of do think 2023 in the crypto space is likely to be, low on funding opportunities, high on M&A, and high on product development across the board.
Well, it sounds a lot like, I don't know if this sounds familiar to you guys, but I did a lot of research on what happened, leading up to the 2008 financial crisis. And a lot of people were, saying like, yeah, in retrospect, what the heck were we thinking with house prices? Like they couldn't keep doing that. But, we had these mortgage-backed securities and the computer models rated them AAA, and we had, 1,000 little pieces of mortgages across the country. And the computer model said it was a 1 in 10,000 year event, that it was going to go down more than 10%. And so it was a kind of thing where when people were in the middle of it, it seemed like it could keep going up. But yet after it blew up, everybody was like, well, that was obvious that was going to happen. I don't know what you were thinking.
I mean, and that's so true of FTX. It's so true of, the startup model, I think is somewhat shocking to people who aren't like intimately familiar with the startup model, where honestly, it's really about upside and not so much about downside. Downside's limited to the amount of your investment. So people kind of get in with, when FOMO takes over, people will put money into anything. And sometimes it's the craziest things that people put money into. I mean, honestly, sometimes what FTX was doing in its funding rounds is just a way of signaling that they're a great, high leverage kind of unicorn status type company from a typical VC's perspective. So it's hard to fault the VCs here. It just was, a little bit too much and a bridge too far. And it's hard to tell when it's a bridge too far because, sometimes when FOMO takes over, you see the very same things happening where people can't do due diligence. They just are either, it's sort of a take it or leave it. You're in the round or you're out. Train's leaving the station. And VCs will do that and they'll play in those games. And sometimes that's a signal of quality under the right circumstances. Obviously, it wasn't for FTX.
It's so interesting because, as you guys know, I live in the Bahamas and I was living in the Bahamas, while the FTX meltdown was happening. And, the community that I live in, FTX owned 8 units in the community that I live in. And we literally watched the staff pack up at midnight and, ship themselves out in this frenzy, like they were, things were dropping out of their suitcases. They were running to taxis to get out of town. Like we saw this with our own eyes. And so for a while, there was almost this shameful kind of like, oh, you live in I work in the blockchain community, and there's this shameful kind of, oh, okay, Cole, how are you doing living in the Bahamas with FTX? Like all my friends were like, told you so kind of, but and I found, even found kind of, as we were communicating, we're not using terms like crypto anymore. We were using terms like blockchain. All of a sudden, this blockchain in the Bahamas, blockchain became the new crypto now. And are you seeing, because Lowell, I mean, you're around the world, you have, clients around the world. Did you see a similar thing?
Everybody's doing it's such transparent, like human nature to gang up on the guys that screwed up, right? And just to be like, I'm not that, and try to distinguish yourself by saying, of course, I would never condone such crazy due diligence. But then again, in the very next deal where there's FOMO involved, they will. And it's just part of human nature. This is why there's these business cycles, I think. It's people get in and they get crazy and they put in money, and sometimes it really works well. And that's the point, is like sometimes, these same signals were true of Facebook, when they were a young hot startup, that people were either in or out of their funding rounds in the late stage. You couldn't do any due diligence. And so it's very hard. It's very hard with startups to really, it's an art to be a venture capital investor, because it's really hard to tell one from the other. And in some ways it's a little bit about luck, and it's a little bit about, people just, I think with crypto, one of the things we just tripped on was the product market fit happened so fast in crypto. Because crypto is about money. It's not about information. You don't have to go build things that generate money. It's like you're building things that like immediately generate money. And so the leverage that these companies had at such early stages kept them early stage too long. And they didn't have all the natural kind of cycles that you'd go through on funding, where you get funded, sort of once a year. And each time you have to prove yourself a little bit more. Eventually you have to do audit financials. You have to keep adding people to the board. That process didn't play out with crypto in a lot of cases. People went from 0 to 60 on product market fit and had giant businesses run by kids and very little adult oversight. And I think that's why I think a lot of the incumbents are out there on the sidelines saying, okay, this is all going to come tumbling down at some point. We're going to be able to step in. And this might be that moment for a lot of people.
Can I ask you, Lowell, and if this is, something you want to punt on, that's totally fine, because it is, but just Cole's making the distinction between blockchain and crypto, and I know I've encountered that a lot, that there are some people that they were big into Bitcoin when it first came out, but they were saying, no, this is just like the real technological innovation here is the blockchain, And, 100 years from now, people are going to look back and just say, oh, Bitcoin and crypto and currencies in general were just the first application of this new technology. Whereas I see other people that, they're saying, no, that's just that's goofy. It's what it is. It's a new type of money, full stop. And do you have a view on that one way or the other?
Well, money, yeah, I definitely think money is one use case, a great one, but it's only one. And it probably needs a whole lot of consolidation. We have so many different cryptocurrencies. I remember back, in the day, we used to make this argument that these were, the reason we coined the phrase utility tokens was, under the Howey test, we were trying to sort of take the position that these things were being used for some purpose, right? And had a use case. And what really would have made that true is if the tokens being issued were denominated in something other than dollars. If they were denominated in a product, then you're tokenizing the product and you're buying the product, using blockchain technology. That would have been a different result, because then it would not have been, none of these tokens would have been fungible against each other. The problem with denominating everything in dollars, the way the 2017 and 18 ICO craze did, is that now you have everything basically in a very hyper speculative mode because everything's denominated in dollars. But I think what we're really seeing now, we've gotten past the currency kind of craziness. We've gotten through NFTs, which had their own hype cycle, but they built the plumbing for non-fungible tokens to now have marketplaces. And that, I think, is what's going to lead us to this place of, blockchain technology being used to tokenize goods and services, not dollars. And that's, I think, where you start to see some real use cases for blockchain start to emerge, when you're tokenizing people's products and using the technology to really create a better way of transferring goods and services, as opposed to a better way of paying for goods and services, which is a very important distinction.
Yeah, a canned question that I had for you, and you just kind of teed it up perfectly, I think, for us, was around the idea of security tokens. I'd love to get you to weigh in generally, just kind of dovetailing on what you were talking about and the fit now for security tokens. And, some people are assuming that they are the path forward, and, others are thinking that somehow some pure DeFi, traditional kind of crypto solution may still exist. I'd love to get you to weigh in on that.
Yeah, and I think the concept of a security token, to me, there's really two types of security tokens. One is a tokenized security, meaning it's a traditional security that's been tokenized, where the token is essentially the stock certificate or the bond. It's the evidence of the security. And in that case, of course, it's a security because the token is the bond, is the stock, it's the share of stock. And so, of course, it's a security for all purposes, US and outside the US. And then there's this really odd animal that we haven't really seen before, which is this investment contract type security, which is really what these so-called utility tokens, I think, wind up being. And investment contracts, it's a very complicated analysis under US law, but you really have to focus on the transaction and figuring out the facts and circumstances of the transaction to determine whether or not you've essentially engaged in a securities transaction, because the tokens themselves, of course, are nothing. They're not rights to anything. They're not securities natively. They're just being sold as securities in transactions that are securities transactions. And that's kind of leads to very odd results for this concept of mutability, where you can think of the token as being a security for purposes of its use in the transaction. It's being sold like a security. It's being sold as a security in this particular transaction on its facts and circumstances. And, I think we'll start to see that, case law emerge as the SEC does sort of the whole regulation by enforcement process. It's going to play out a lot in the courts, and we're going to start to see some of the judges decide on some of these open rules. But I definitely think, at this point, we, from a US law perspective, the investment contract style tokens you should just plan to treat them like securities. And then on the security tokens that are just tokenized securities, yeah, I think that's a huge use case for blockchain technology to enable traditional securities and financial instruments to have a more native transferability, a more native ability to pay dividends, to pay financial returns to wallets using crypto, using stable coins, perhaps. There's all kinds of interesting things in just the traditional security world that I think are streamlined and created a little bit better with this new technology to tokenize a security.
I have a question here, Lowell, because I'm just trying to remember back to when I first got into this stuff, and it was, Cole who actually got me thinking more along these lines. And I know that I initially was hesitating because I thought, to the extent that, some digital token is a claim to something else, whether, it's a share of stock or a bond or something, I thought, well, doesn't that defeat the whole purpose? Because doesn't that mean you need a trusted third party then to honor that claim? And I thought the whole point of blockchain and crypto was that we solve that problem and nobody can shut it down, and I don't have to rely on somebody's reputation because it's just a community and there's this public ledger. So for people who, they understand the basics of Bitcoin and what it's supposed to be and what it was supposed to give us, can you speak to that at all?
Well, yeah, I would say in general, when you're focusing back on kind of tokenized securities, I think there's a lot of interesting things blockchain can do for you, but you have to pick your battles. And it's not even picking battles. It's more about deciding, kind of what really is going on and what is really the innovation here. The laws aren't going to change. So, at some level, I think what really ends up happening is you have much easier atomic settlement, kind of this notion of T0 and not having to wait. So in some ways, you could say that the only real innovation is maybe the clearance and settlement piece, but that's a huge piece. I mean, it's a giant piece when you think about the, the world's capital markets and the back offices that go through the process of clearing and settling trades. So it's an enormous opportunity. I think there's other things too. I think there's auditability, there's trust, I think comes into play when you use a blockchain technology. It's much easier to audit and be certain that a counterparty has the securities that it claims to have. And there's ways to, there's challenges associated with figuring out how much information to put on the blockchain and how much to keep in proprietary ledgers, but that's all happening. I think we're starting to see, again, projects that are figuring out that you can't keep everything on the blockchain, but you expose the trade data, the kind of the relevant data. And I think all of that's going to get worked out as technologists figure out what's needed, but the laws aren't going to change. And so people have to build the tech to the law and use it for its purpose of like making things faster, but also more secure and auditable.
All the VCs that are out there, anyone that's looking to deploy capital, any dry powder that's kicking around early 2023, how important is it for these people with the dry powder, with the capital that's ready to be deployed, to be, talking to founders? And, is it important for founders to convince VCs that they have a grip on what we're talking about right now on, what is a security token? Should a VC or an investor be asking founders, what do you know about this? And is it a red flag if they don't understand, say, security tokens or tokenization or blockchain technology? I mean, how relevant is it at the macro moving forward?
Well, yeah, I think investors, this is the perfect time for investors to really get, this is when you buy low. And so it is time for investors to kind of get educated, get involved. And the nice thing about the, kind of being in a market with less FOMO is that there is more signal to noise. And so investors are going to have a much better time. They're the buyers in this market, and it's a buyer's market. So they should be taking advantage of this, not sitting and waiting on the sidelines, in my view.
A few times now you've said how the laws aren't going to change, and I guess that surprised me because I know you teach a class on these things. So I don't know. I think some people just reading the headlines or whatever, and certainly politicians are spouting off. They have strong views on FTX, and Elizabeth Warren's not afraid to share her views. So I'm wondering, can you just talk a little bit more about that? So meaning you think that the basic principles are laid down and they're just going to apply them to this new area?
Really, I could say something snarky about Congress's ability to legislate today, but what I really mean is the latter thing, which is the basic premise behind the laws, the concept of suitability requirements, the concept for broker dealers, the concept of trusted intermediaries. There's a reason that they're there. Blockchain can deal with things like clearance and settlement and make that better and disintermediate people in that business. But the general idea of a broker dealing with securities there's a bunch of other reasons besides clearance and settlement. And that's why I'm just saying, certain things are going to be disintermediated, but not everything. And you sort of have to figure out which ones are capable of being, take for example, transfer agents. Transfer agents play a really important role. You could say, well, why do we need transfer agents now? I mean, everything's happening on a blockchain. But the reality is there's so many like nitty gritty things about like what happens when a spouse dies or there's a divorce. Every issuer is not going to want to deal with those kind of things, right? So there is a reason for transfer agents to continue to exist, and blockchain is just going to make their job easier because it's a lot more transparent and auditable. So they know what the records are. But transfer agents don't just do record keeping, and that's kind of a fallacy. So I think that's sort of the point is we have to, as entrepreneurs, think about, well, what is it that makes sense as an end state here? And what's going to be outsourced? What does blockchain really do for us and do for us well? And what needs to remain as sort of an outsourcing function? And I think transfer agents I think blockchain is going to be a great thing for transfer agents. It's going to make them even more profitable.
The number of times that I've had advice from people like you or Bob, as I've been looking at involving myself in some degree of blockchain technology, the number of times I've had people say, yeah, Cole, I'd really like to take your money, but you don't need blockchain for that. I was always disappointed. I'm like, a lot of founders, I think, are building projects backwards in this day and age, where they think, well, I'd really like to be in and around blockchain or security tokens or crypto. I mean, it's sexy. There's FOMO, as you pointed out in the space, but could I just really use a spreadsheet for that? Would that solve the same purpose? So yeah, it's a completely fascinating conversation. And there's a question that I really wanted to ask you. It's along the same lines, but kind of slightly going in a slightly different direction, is in and around XRP and Ripple. What are your thoughts? Is it going to have an impact? Is it going to drive markets? Is there going to be some kind of a bubble bursting? Is it the dagger in crypto, or is it a breath of fresh air?
Well, gosh, I don't know where these court cases are going to wind up. I think, I sort of alluded to it earlier. There's a lot of these cases floating around that the SEC seems to be taking this more of a approach of allowing the courts, frankly, to make the decisions. And by bringing these cases, they're turning it over to judges. And maybe that's the right answer, but it's, at the end of the day, we're going to figure out, I guess, through case law, what is a security and what is this mutability mean and where are we going to go from here? But whether it's the library case or the Ripple case, I think there's some really important questions about, even if something might have been a violation on its facts and circumstances at the time, is it still a security, today? And that's a really important, I think, question for a lot of, all the Coinbases of the world that are trading all these utility tokens. They want to know, are these things securities today, or have they transitioned to commodity status? And I think that's a very big open question, honestly, in the case law that cases like Library and Ripple may start to shed some light on. And, it would have been nice if the SEC sat down and really thought this through and came out with a position. That's sort of what we had advocated, is let's come up with a, more of a rulemaking safe harbor type approach that makes sense. But it's really hard to do that. I mean, it's, in some ways, throwing it to the courts makes the most sense to me anyway, because it was probably always going to end up there. You probably wouldn't have come up with a thing that pleased everybody anyway. So we probably would have wound up in court. But that's where we are, and we're going to see what some of the judges think here. And some of the cool open questions are, when you look at an investment contract type security, historically, when things were an investment contract, we just didn't do them. We just didn't move the project forward. We just said, oh, sorry, you're violating securities laws. But with the advent of crypto, we now have this crazy product market fit for things that could arguably be investment contracts. So we are having to figure out what that means. Like, we don't have line item disclosure requirements for investment contracts. We have it for equity type securities and debt type securities, and that's it. And so it really becomes an interesting thought experiment in terms of, gosh, what are, investment contracts? What's material to the holder of the investment contract? The issuer doesn't always have all the answers, when you're talking about something that's completely decentralized, where the value proposition of the token is dependent on a whole bunch of projects that are creating the demand for the project. It sort of becomes this decentralized thing that nobody really knows what information is going to move the market, because the features and functionality are just not moving the market anymore. It's really demand. And once that demand becomes totally decentralized, you have a very interesting problem. So that's, I think, figuring out where and when and how these investment contracts changed from being investment contracts to a non-security transaction when you sell the token is a tough one.
Has there been the definitive case yet? You know how like we talk about the Howey test, for example, and that it comes from a particular ruling, or, you know, in other contexts, Roe v. Wade or the Dred Scott decision, Marlboro versus May. You know, there's these seminal cases that were, you know, established what the criteria would be for a while. And maybe, you know, in some cases, of course, they're overturned. Have we had that yet in this space, or is it still too new and there's not been the definitive thing that guides future judges?
I think there's a lot of open questions in crypto, even with the whole line of Howey cases. I mean, the whole idea, for example, I mean, I'll just throw out there, you know, quite frankly, the whole idea that a mere implication of a financial return associated with secondary market trading, that could be a sufficient financial return, is really just dicta in a couple of cases. It's not even a holding from the Howey case law. And so there's a lot of areas where I think judges could differ from the SEC on this stuff. But I think as a very practical matter, that's incredibly unlikely to happen. Judges don't try to overturn the regulator very often.
Mm-hmm.
I think they go along with the regulator as much as they possibly can. And that's the very practical reality here. So I think, you know, the SEC's views are going to matter. And, you know, it's only going to be in cases with the right facts that you're going to see the edges of some of these open questions be nibbled away. But one of the really crazy open questions, I think, is, for example, should you look at each set of facts and circumstances for each transaction and determine whether that transaction was a securities transaction? So maybe primary sales are securities transactions, but secondary sales are not? I don't know. That's an interesting open question that's sort of probably the right answer is to think of it more temporally and look at all the aggregate facts and circumstances that are in the market at a particular point in time and say, okay, based on those aggregate facts and circumstances, we're going to treat this token like a security for all purposes and all transactions. And then at a different point in time, you know, you measure again all the aggregate facts and circumstances and say, okay, now it's no longer a security. I think that would be a more sensible way to do this. But honestly, this is an open question that I think, you know, whether you go transaction by transaction or whether you go temporally, you know, aggregate transactions for a period of time, I think is something that the case law is going to have to work out, because we just you can't really tell. There's at least one case that says within a transaction, you don't, you know, it doesn't make sense to try to determine whether something's a security for one purchaser versus another purchaser, which sort of makes sense. So that's kind of why I say I think the aggregate approach, not just within a transaction, but across all transactions, is probably the more sensible approach for a whole variety of reasons. But I could see case law change. You know, the case law is open. A judge might say, hey, you got to look at every transaction, and therefore, you know, secondary sales. Coinbase would love that, right? I mean, if somehow all those secondary sales were not securities transactions, but that's some of the stuff that I think could theoretically get decided.
Mr. Howey and the Howey family have been made kind of famous over the last few decades because of, you know, the number of times that we've referenced, even in my life in the last 4 or 5 years. Do I satisfy Howey? Do I satisfy Howey? The number of times I've been trying to satisfy this guy has been remarkable. So you're kind of suggesting then potentially there could be a new Howey moving forward. Is that fair to say?
It's really the same Howey, but just with some of the open questions answered. That, you know, there's only so many cases and so many issues that have been decided on this topic of what is a security, and those cases that are out there leave open some of these questions that relate to investment contracts in particular. That's where I think we can see some case law actually being significant here, is answering some of the open questions on investment contracts.
For business leaders who want to incorporate this technology or they're considering it, is it this case, Lowell, that there's a clear-cut way to do it where you're totally, you know, in compliance, and then there's another way where, well, depending on how rulings come down, you might be okay, but you might not be? Is it like that?
Well,
or is it like nobody knows anything about what's going to be the case 2 years from now?
I do think, out of an abundance of caution, the sensible thing to do is to adopt the SEC's hand wave here and just say all of these utility tokens should be treated as securities under U.S. law. I think this is another area that's kind of novel, right? We're seeing, like every other country, maybe other than Canada, that seems to also apply a similar test to Howey. The securities laws outside the U.S. really don't go as far as how he does to essentially encompass the concept of a very implicit expectation of profits, that's not necessarily written in any kind of bilateral contract. And so I think, outside the US, you have a much different analysis under the laws and cases of other countries. So here we just really are, to me, the way to go today, if I'm corporate America, is treat it like security under US law, but recognize that it's probably not a security and probably can't be traded by broker dealers outside the US for that reason. And so you have this crazy dichotomy then. It can trade in these centralized non-US exchanges as a non-security, but they have to exclude US people because if you involve US people, that's a securities transaction. Again, it really comes back to this idea that it's the transaction that you're looking at, not the, it doesn't make sense to ask, is the token a security? Because the token is not a security natively. It's how the token is sold and whether it's being sold in a transaction that's got securities law implications. Again, that goes back to the open question of whether you look at each transaction or you look at all transactions in the aggregate and say, we're going to treat it like security across the board, including secondary sales. But again, the conservative thing to do is to put all that aside and just say, let's just treat it like as if it were a security today for all purposes and come up with an exemption for it and, live with the exemptions. And we have exemptions we could use for a lot of this stuff. Some of the places where it gets hard, I think, are in some of the play to earn. There are some open questions, I think, on even treating it like a security that we could really use some answers in terms of rulemakings, or some of the speeches could be helpful if we really started to focus on exactly how should we be doing this, in terms of treating it like a security. But that's the answer, is just treat it like security for US law purposes.
Yeah. And, being a founder and having been in the trenches of this for the last 18 months or so and, boots on the ground type approach, I've found that the SEC and the exemptions really have allowed us to be put in a successful position to be able to access the global market and, still be able to serve, be compliant, work within the daylight, still satisfy our scratch the blockchain kind of token itch, as it were, and keep the US regulators happy. And it takes a lot of stress out of our life because we don't have to be coming to people like you all the time and going, could you look at my stuff? Am I a security? Am I not a security? I mean,
Right.
The number of times, so when you go out, for example, you're at a dinner party and, people, okay, there's that guy's an attorney, he's the top of his field. Go over and, do people come up to you at social events and things and say, hey, can you look at my deck? Am I a security? Am I not is this a common question?
It is, yeah. I get asked at least 4 or 5 times a day, and on each, it's the beginning question to every call I have with clients. Yeah. And I just, my playbook these days, in fact, honestly, ever since I sat across from Bill Hinman and he sort of said, we're going to accept your proposal to give some guidance here, I stopped giving guidance. I said, let's be consistent with the SEC's hand wave approach here, because that's who matters. When you get into court, the court's going to give deference to the regulator. Nobody wants to, I get that. I really do. And my heart is in it. I love the academic arguments about whether or not something should be a security. But I just think, honestly, to be pragmatic here, you should just treat it like security and be done with it and move on, because we all know how to do that. And so that's, to me, the path of least resistance right now until case law changes, the result.
Yeah. And I'll just follow that up by saying that the industry has, even from a traditional blockchain or crypto perspective, a lot of the layer ones now are working with transfer agents and, ATSs and investment banks that work within the daylight of the idea of a security token, for that matter. And there's some infrastructure that's been built out around kind of still achieving, again, the blockchain dream, but yet doing it in a compliant way and still being able to be innovative and super creative and, offer that deep value that, the blockchain and a lot of founders really dream of, the kind of let's change the world approach to things. The next question I kind of had for you really quickly is just to kind of give the viewers something kind of tangible, is what do they need to do? What does a founder need to do? What does a CEO with some infrastructure, a good deck, a good business plan need to do to attract a good attorney, good legal counsel, understanding how important it is in this space? I'm assuming there's a high percentage of things that cross your desk probably just don't really fit the pass the test, so to speak. So, what advice could you give to these people? How do they come prepared? How do they attract someone like you?
Well, I mean, again, back to boring is the new sexy. That's kind of been my watchword too, is the more you come to the table with that sort of attitude of let's figure out a compliance strategy as opposed to let's figure out a strategy that is, going to take us to the moon. It's interesting to watch the change in that attitude occur because I've been doing this for over 10 years now. And I can remember in early days, people were like, look, nobody knows the answers to this stuff. We're very risk tolerant. And we just want to make sure this works. And we can go do this and not go to jail. And now people are more saying, look, we don't want to take even the risk of the appearance of impropriety. So I think things have actually, I think the SEC's done a reasonably good job of actually kind of beating the crypto market over the heads and getting people to a place that's a little bit more compliance oriented. And honestly, I think I know everyone's going to sort of hate me for saying that, but look, I've been in this since early days and there is a place for the regulator. The fraud has to be eliminated. We're not going to survive as an ecosystem with a bunch of rampant FOMO-based fraud. It's gotta be stamped out, and we need a regulator to do that. So I think, maybe it's not the SEC the SEC may not be the best regulator here, because if really we're trying to eliminate is fraud, maybe the CFTC is the better agency for that. I don't know how disclosure really helps. I mean, when you think about providing audited financial statements for a token issuer where the token holders have rights to nothing, it's worse than useless. It's actually misleading to provide audited financial statements implying that token holders have some pro rata share of the financial results of this corporation when they have rights to nothing. So I worry a little bit about the SEC as whether or not that's really the right regulator. But, the CFTC, I think, has started to get more active in going after fraud. And that's what I'd like to see. I think that's probably the more sensible regulator here with, spot trading being a little bit looser and easier and a recognition that what's really going on here for the most part is consumer protection issues around fraudulent statements of something consumers are trying to buy for its speculative value that may not come true. So I'm not sure disclosure is the right solution. And really the SEC is a disclosure-based regulator. So I think that's kind of my 2 cents. But, I'd love to see the CFTC get a little bit more active.
Do you have a sense, Lowell, and again, I know maybe it's a delicate thing and you got to choose your words carefully, but to the extent that you feel comfortable commenting, because I've seen that typically what happens is the regulators are behind the curve when there's emerging technology, even something like I know I was talking to people that were involved in, hedge funds and they were doing lots of complex things with derivatives. And the guy was just telling me that, the regulators showed up and they're walking and we had to say, no. See, this is what you need to be looking at. See how we're in compliance with the regulate, and that the people who showed up, he was telling me we wanted to be compliant just because we were. So why not, but we could have told them anything. They didn't even know what they were looking for kind of thing. And that seems to be a pattern where the people innovating, where you're going to go make $20 million versus having the, nice paid job and job security working for the government, that the true innovators are going to be drawn to the former and that, there's always this lag.
This is going to cut against what I just said about the SEC versus the CFTC. I will say that the SEC was on top of this from the very moment it began. I mean, I can remember back in, I think it was 2013 or 14 when I filed a registration statement for the T0 project for Overstock, getting on the very first call with the staff. Usually you file a registration statement, you get a call from a examiner on the staff, and it's some junior person just as a courtesy saying, yes, we're going to examine your filing. So, make sure you don't try, just be prepared for comments. It is really the nature of this call. I got on this call for this Overstock registration statement, and there were 40 SEC folks that were there. Amy Starr was incredibly knowledgeable back in the very early days. So to their credit, Val Spanik and Amy and others, you see them at the meetups, you see them, really digging in and taking this seriously. I'm actually surprised at how seriously they took it, even in those early days. I can remember even in 2016, going and talking to the, Mnuchin's treasury guys and getting basically this answer like, wow, this is BS. This isn't even real. We're not even going to pay attention to it. We don't care about stable coins and all this garbage you're talking about. And, we're like kind of raising flags like, hey guys, Treasury needs to be thinking about this, and it's happening. It's kind of an important thing. So some agencies, even in like 2016, were not getting it when the SEC got it as early as 2014, 13. So I give them a lot of credit for being on top of this trend and actually being very knowledgeable and talking the talk and going to meetups and understanding what gas is, and they get it. So they're on top of it. It's not a lack of paying attention. It's just whether or not is disclosure the right solution, to me is the dividing line about who's the right regulator.
Yeah. And just that is so well said. Just to be respectful of your time, maybe you indulge Bob and I for one more question each here.
Sure.
And I'm taking a ton of value from this and super enjoying this conversation. It makes me think a lot about education. And it makes me think a lot about, what's maybe from a security token marketplace, like what's happening in the primary market versus the secondary market. You talked about T0 and other, say, security token exchanges. There's the Securitize and INX and Oasis Pro Markets, and and these different kind of secondary markets are popping up all the time, in the space. And you're looking at the market cap of security tokens, secondary market cap of security tokens, and it's really skewed. I mean, the information that's out there is just all over the place. How much emphasis is on, people in the space right now to educate the end user, the people that would be buying into the secondary market and the security tokens marketplace? How many people in the primary market do have that emphasis? And will it eventually solve a lot of problems of, like you said, understanding gas? I mean, that's more of a kind of a crypto term, but as we enter into the security token space, how important is it to be educating, say, the retail investor?
To me, that's not even necessarily a crypto. If what you're really talking about is just a tokenized security, then it's all the usual disclosure requirements for a tokenized security. I definitely don't mean to suggest that tokenized securities should be regulated by the CFTC. Like, for sure, something that's a traditional security that's just using a token as its stock certificate is a security that should be regulated by the SEC, subject to all the usual disclosure requirements. It's just these rights to nothing, these investment contracts that have this property of going up in value in secondary markets, that I think may be better served by the CFTC because of the fact that they're rights to nothing. And providing disclosure about an issuer of a right to nothing is at some level misleading. And so that's, I think, and we struggle so mightily to figure out what is the relevant disclosure to a token holder when it's a right to nothing. In some ways, it's a similar argument for a startup company when you're talking about even the equity of a startup company. It's like, what's material? My God, I mean, they're probably going to fail. So you shouldn't really buy the security. I mean, that's really like, do you need to say any more than that? It's a sort of an interesting question, right? Is what actually, this is two guys in the garage with a dog and they don't have any money and you probably shouldn't buy any of their securities. That's the disclosure, right? That's relevant to the investors of an early stage startup company. And I hate to say it, but there have been some speeches lately that are sort of implying that we're going to have more disclosure for early stage companies. And I guess I would just, really recommend people think about that pretty hard, because we have a very vibrant startup practice here that has led our, to U.S., hegemony in the tech industry. And we do not want to screw that up. So look, people are going to invest in startups, they're going to take flyers. And I think we've got the right, accredited investor rules in place to keep the moms and pops from overdoing it. They may be paternalistic, a lot of argument about that, not letting moms and pops into a company as dynamic and interesting as Facebook. But I don't know, that's what we've decided to do. And I think it works at some level to keep systemic risk out of the capital markets. So keep doing what you're doing, I would say, from a disclosure standpoint, and don't go overboard on some of these early stage things or these rights to nothing. I mean, we shouldn't have to say a lot more than it's a right to nothing, guys. It doesn't really have value.
So if you could indulge us with one more, I guess Cole's given me the honor of the last question here, Lowell. So, you're looking at your bio and you're doing a lot on just digital currencies and trying to educate people on that. In my circles, people care a lot about monetary policy. They're very skeptical of state-issued fiat currencies. And so a big topic now is this the so-called CBDC, the central bank issued digital currency. And again, you made an interesting distinction earlier in this discussion about there's one way that, people might want the world to be, but then there's how it actually is. So I'm wondering, like, just to pick like year 2050, do you think it's going to be like, are the peoples of the world going to use a currency that's issued by their sovereign government's central bank? And that's going to be the primary money that's in use on planet Earth, is respective politically issued currencies that perhaps, in digital form?
Well,
or do you see it more like market issue?
I mean, my reference for the future is always Star Trek. And I just don't see a lot of big, thick wallets in people's back pockets in Star Trek, right? And so I do think eventually all currency is going to be digital. It doesn't make sense it's such an anachronism to walk around with pieces of cotton with writing on it. I mean, it's ridiculous, right? So yeah, digital currency for sure. And I think there'll be a central bank version of digital currency, and that solves a problem. But you still got, this monetary issue, policy issue, that there'll be plenty of room for stores of value, like perhaps Bitcoin, to essentially disintermediate gold, right? Not the dollar, because it's an even better fixed supply type store of value than gold is, because it's more natively transferable. That's one of the things that I think people miss about digital currency in general. They sort of say, well, isn't it a tulip? Doesn't it have no intrinsic value? And boy, the answer is no. The technology makes it so incredibly transferable. Unlike tulips, you can't transfer tulips very easily. It really has the intrinsic value is its inherent sort of technology ability to be transferred and traded and be tracked and be used. That may not sound like intrinsic value, but it's huge intrinsic value from a human history standpoint. Having something that can actually be this fixed supply thing that everybody just agrees is valuable, the way that everybody agrees gold is valuable, but it's a lot more transferable than gold, is a huge intrinsic value. So I think you're going to see CBDCs for sure, but you're also going to see some of these digital currencies winning out over as the store of value that is the flight to, non-CBDC.
That's an amazing way to wrap this up. I'd like to thank you, Lowell, sincerely on behalf of Dr. Murphy and I. I know that any founders, future or present, watching this are surely took a lot of notes and surely took away a lot of value. So yeah, thank you very much.
My pleasure. Happy to talk to you guys.
This concludes another episode of the Founders Forum. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the hosts and for previous episodes, visit foundersforum.io. Thanks for listening.